Okay, so if you watch me each day, you know that my outlook on things is the glass is half full. Okay, I've been taking flack from people for years. I've said there wasn't going to be a housing crash, and people disband me, and so now I got some concerns. Okay, so here's the headlines that we have for today: No jobs report leaves Fed flying blind. Government shutdown proceeds. But when you start looking at the markets, okay, I get this. I get this right through here. Yeah, mortgage rates are going to come down. Were they going to come down plummeting? I'm going to go through a few scenarios with you guys, based on the data that hopefully we get someday here soon. But if you go over to the markets with the government shutdown, no economic news, Dow Jones hit a record high. You had the S&P, all these indices are record highs. You got the VIX not really moving at 16, so the anxiety level on Wall Street's not there. You got cryptocurrencies hitting record highs as well, and you got oil coming. Well, it's right at $61 a barrel, right in line. So when you start looking at the data, what makes things as good and as rosy as they are? And I think it's just euphoria right now. That's the only thing I can see. I watch CNBC and all the financial channels all day long. I watch it all night. I analyze all this data. And hey, folks, I'm just like you guys. I'm loving this stuff. If you go over to the rate update portfolio, we're making money. Bitcoin, you guys know I own Bitcoin, and that's up to a record high now. And if you're invested, you're doing well. But then you start looking at the technicals, and even the financial analysts, they're starting to say it now. Everybody's starting to move from just pushing everything to things are a little frothy right now. So when they start saying it, they already know something. So they're probably putting themselves in positions. So here's kind of our portfolio. So let me just retrospect. I'm not in the mortgage, or I'm not in the business for a mortgage right now. So let me caption this as what I'd be looking at. So let's say I want to buy stocks. Is it a good time to buy? So you can kind of parallel this with, you buying a house or refinancing. So what am I looking at? Well, is the stock going to go up or down? So again, let's correlate it to where mortgages are going. So is the mortgage rate going to go up or down? Okay, so it's based on some of the fundamentals on our economy. Those are, if you go over here, the national debt. Okay, this thing doesn't look like it's slowing down at all. If you go to how much in debt are we so far this year? Well, it's 1 point. Wait a second, it's not moving. Hold on. Oh yeah, they aren't able to fund themselves up through here. They can't fund themselves. So we don't know how far in a deficit we are right now as well. So this thing doesn't look like it's slowing anytime soon. Then you throw on top of that, I'm just saying, you might have a tariff thing that comes out to be illegal. So what I'm trying to say is, hopefully you guys watch me for the truth, okay? And we're trying to, focus in on kind of relabeling ourselves. TRU, the rate update. Well, I'm just going to provide you the truth. Okay, so let's dive into some of this data that we're looking at. And I basically put it down through here. Let's look at some scenarios that we're most likely going to get. All right, so I'll put this on our weekly blog, and this will be it'll be titled this. It's not there yet, but I'll put this down through there. And I put in some scenarios. I said bad jobs plus inflation, job stable plus inflation low. Basically 4 scenarios through here. Okay, and it kind of gives you what most likely is going to happen. But down through here's a pretty much easy to read chart. So let's go through the 4 scenarios that most likely are going to happen, or these are probably the only outcomes that can. Let's say we get a bad jobs report, meaning the jobs market did bad, and higher inflation. What's most likely going to happen? Well, the 10 years going to go sideways or maybe up. You can see rates at 6.5, 6.75. So is that most likely what's going to happen? It could. Okay. I'm just giving you the scenarios, and then you can kind of figure it out. I'm not here to kind of tell you what to do. I'm here to give you all the information so you can help decide. And then I'm also going to give you tools how to make this a little bit easier for you. And then you can look at over here. Let's say it's a stable jobs market and lower inflation. I don't see that happening, but what would happen? Rates would go, conventional rates would go about 6, and FHA and government loans would drop down below 6 now. We're kind of here right now. We're kind of right in this area right through here. So that's best for buyers, steady relief. Okay, so now let's say weaker jobs market and lower inflation. I don't see that happening with the lower inflation piece, but what would happen? Well, you'd have the rates would plummet. Because they're saying, okay, inflation's coming down. It's right in our wheelhouse. The Federal Reserve is. We got a weak jobs market, so we're just going to keep lowering rates to keep up with this. But right now we have this tariff threat on top of us that this probably isn't going to be likely. It might be stable, but in most cases, it's going to be, where it is now. And then a strong jobs market and higher inflation. Well, then they're going to say, well, we really don't need to cut, and that's not good for us. So they're going to just keep pumping up rates. So if you look at this, what's it looking like? Well, in the perfect world, you got down through here. Could rates go down below 6 for most people? Well, if we get a weak jobs report, well, I'm going to give that a thumbs up. And lower inflation, I'm not going to give that a thumbs up, because we know, and I even say each day on the channel, tariffs are inflationary and they are going to push up the inflation rate, and it's going to push up the rate that the federal funds rate's all tied to and everything else. So you're not going to see lower inflation until we have a lot of data in regards to tariffs. And even just a smidgen, when China signs and everything else, you're still going to have inflation going up. So you're probably going to have higher inflation, bad jobs numbers. Let's just say it's a stable jobs market and lower inflation. Don't see that, but I'm just going to say stable inflation, or inflation a little bit higher, and basically a weaker jobs market. So we're going through here. So you're going to be in this range right through here. Okay. So where are we now? We're basically in that range. If you go over to where mortgage rates are today, we're pretty darn close to that. So the ability for these to go down more, there's probably an 1/8% rate that's going to come out of here, and all the way across the board. I don't really see it dropping any further until we really have the tariff relief. So that's the focus there. And I'm going to keep saying the same thing. If you follow me also on our Stock Talk Tuesday, where we actually talk about stocks and how to invest and things like that, we're going to hit today because Pelletier, I just added this on here because it was the tech stocks that I'm afraid to jump into, kind of like you guys are. If you're looking at homes, it's scary to say, okay, that house is, but what is that? What did that house do since last year or the year before? Okay, did it plummet in value? Well, good for you, because so you held out, the house dropped in value, rates are coming down, you did a good job. But did the houses in your market, did they go up? Did your rents go up? So I'm not trying to explain to you guys what to do and how to do it. Let me give you some tools. Okay, so let's go to my website, and we'll get to some other things in a second. I have a website, and here it is. And we have a slogan here. So my name is Dan Frio. I'm actually a licensed mortgage loan officer. So if you have first time watching my channel, I have a slogan here. It's one application, one credit pool. We're going to compare your loan to over 30 different lenders. Now, that's what my slogan is. I'm licensed in all 50 states, folks. So if you're out there looking to buy or refinance, I'd love to help you. What we do is when you apply with us, we're kind of like a broker, but we're actually a bank that's has a federal license throughout the whole country. We have over 30 different lenders that we're partnered with, that we can offer you their programs, their rates, and all kind of different things. So check out our website. If you're looking for a refinance, just hit the RateWatch tool right here. What you're going to do is tell me what rate you're looking for to refinance. And then if you've already have a loan estimate from a lender, just put that in here and we can compare it with over 30 different lenders. So let's go back to what we're really going to focus in on. Here's what we're going to focus in on: the national debt. And here's the data that the Federal Reserve monitors. But the problem is, if we're going to go to the economic calendar, they watch inflation, they watch the unemployment rate, they watch GDP, and they control this rate right through here. So if we go over to the economic calendar for next week, we have Monday and Tuesday, there's no data because there's no government. Okay, Wednesday, we're going to get crude oil inventories, the 10-year Treasury auction. We'll see how that goes, because however that rate goes, hopefully it goes down a little bit. That's going to drive down rates. And if we can close the 10-year Treasury, going to give you a keynote here. If the 10-year Treasury can close below 4% for the day, maybe hold there for a day or two, you're going to see a massive amount of people jumping in and buying, saying, okay, that's a technical now that gives us a top end. So people are going to rush in saying, okay, rates from there on are going to go down. So there are some technicals coming up that could work in our favor, but we're really not going to know, because we're going to get the FOMC meetings from the last meeting, but now they're going to say, they're going to give us, basically tell us what exactly they thought behind the scenes. But now here's the data we're not going to get. Federal Reserve Chairman, I guess he'll speak, but we're not going to get initial jobless claims. We're not going to get continued claims. We're not going to get any of the data that's really giving us a direction on where rates are going and where what the bond market's going to do. And also down through here, here's the biggest news we usually have in the week: non-farm payroll, the unemployment rate, and everything else. And we're not going to get any of this. And again, this is important because when you go to the caption here, Federal Reserve's flying blind, and basically so is the market. So what they're basing everything on now is they're saying, okay, based on the data that we have, like this week we had the ADP payroll numbers. They're horrific. Okay, just to put it in context, they had the last time their reading came out, they had like 50, I think it was 52,000 people got jobs. They revised it to a negative 3,000. So that's 55,000 lost, if you follow my math. And then they came out this time, they thought there was going to be a plus 54,000. Kind of once again, it came in at negative 32,000. And they're saying they recalibrated the systems. Well, if you look at take all that data together and you're saying, okay, this can't be good for the jobs market. Then we have a government shutdown that's going to let tons of people go. Then the immigration situation we're in right now. So the jobs market's going to really suffer. Okay, so then you look at it as wages and wage growth and things like that. What's going to happen with that? Well, most likely the wages are going to go down. So if you're struggling now, it's going to be even more of a struggle. Those in the game, those that have the money, you're seeing, unfortunately, you're seeing this happen, and they're making more and more money. That's why I keep out each day and come in and try to educate you guys on the economics behind the markets, how the markets move, why they move. Stock Talk Tuesday. I'm not a broker. I'm just trying to help you guys understand the markets, how to invest, and just hopefully real estate as well. So let's kind of go break down this. If you got any questions, that's what we're here for, folks. I don't do a closing bell on Friday, and this Friday, there's really nothing going on anyways. So I get it. If you're sitting out on the sidelines and you're like, okay, what do I do? So if you're a home owner, let me give you some tools that you might be able to work with, because again, the pendulum's telling us we're probably in the sweet spot right through here. It's saying rates are going to be between 5.75 and 6.25. Okay, we're kind of there now, but they could go up from, the pendulum here is 5.75 to 7. Where are we now? We're basically right in the middle of that. So the tendency is to stick here. Could you pick a bottom? Yeah. Let me help you pick the bottom. Let me go over and show you a new tool we just put in here. Now, this tool's been here for a while. It used to be posted up through here as saying refinance. Got a little confusing. So we're going to change this to RateWatch. I'll put under here 2.0 because that's what we're really pressing right now. A lot of people, the questions is, should I refinance? How do I refinance? This is going to give you everything. Okay, so what you're going to do is click the button and just give me your information. You're going to fill out and tell me what exactly your information is on your mortgage. Okay, and then tell me what rate you want to refinance at, or at least look at the numbers. Okay, so what will happen is during a series of emails you're going to get as well, you're going to understand how all this works and how we're tracking, and I'm tracking it behind the scenes. So don't be wowed if one day I'm calling you, texting you, emailing you, and saying, hey, your rate watch just triggered. Let's go through some of the numbers, and we're going to break it down. We're going to go over what your new payment's going to be, what the cost would be, what your break even. All those are important. So one of the things we'll educate you on is when you're refinancing, the cost of a refinance is a fraction of what it is when you bought the house. So we can even use a title company. If you used one in the past, you got a friend that works there, be more than happy to use any title company you want. So that's how that works. What other data do we have for you today? Like I said, if there is any questions out there, please feel free to let me know. But let's do a recast. Okay, this weekend we saw basically, I'll just say mortgage rates were pretty much flat all week. They didn't really do too much, up just a tad each day, down a tad each day. The stock market, they're hitting record highs each and every day. But my concern right now is the markets are a little frothy. And if you look at mortgage rates right now, they did drop a little bit right through here. Right through here. But if you have to actually go to the MBS market, what we're seeing right through here, it is down. It's actually down 10 ticks. So in most cases, those 10 ticks would equate out to basically rates going up. So let me explain to you guys how this works. So if you're new to my channel, I want you to understand what we focus in on and how we kind of know exactly what's going on with mortgage rates. So there's different bonds people look at when they're trying to figure out what's going on with interest rates. So a lot of people follow the 10-year Treasury, and you can do that because it's widely available. And what you want to do is just watch this. So if the 10-year Treasury bond yield's going down, whatever your mortgage rate is, I don't know exactly where it would be because everybody's rate's a little bit different, is that rate will come down as well. But if you see the 10-year Treasury going up, that means most likely your mortgage rate that you were quoted is going up as well. So since the Federal Reserve cut rates, let's see if we can find that. Actually, the rates went up. Same thing. This was about well, actually, the day the Federal Reserve cut rates, the 10-year Treasury was at 3.99. We were able to lock people in. How? Let me show you how. Go back to this, the RateWatch tool. That's how everybody's taking advantage of it. So we don't sell this data. We just make sure we're informing you guys on when you can refinance. So that's what's going on in the bond market today. Again, on the economic calendar for next week, we got no data. So each day we're going to come in and focus in on different things. And I'll show you next week. We're going to go over and watch what the dollar's doing, what the 10-year Treasury bond is doing, and what it is basing its movements on. And that's the backdrop that we're going to have. So we're going to go in each day, like I do always, and come in with the opening bell and the closing bell, let you guys know how all this is going. But Federal Reserve, what are they expected to do at the next few meetings? That's pretty intriguing right now as well. So if you go to this, you can actually go to it. You can find it at cmegroup.com/markets. You're going to click probability. The probability, look at that. The probability of rate cuts. Let me zoom that in a little bit for you. At the next meeting, as we were saying just a little bit ago, right now the federal funds rate, where is that thing? Is right through here, is 4 to 4.25. If you go over to here, that is over here. So this is actually telling us there's a 97% chance that the Federal Reserve is going to cut at the next meeting. I think that's baked in, and I think the markets are anticipating that. Then they're also anticipating another 85% cut in December. Now, this is where it's going to be intriguing, because if this data doesn't come in exactly as they want it to be, kind of like those data points we looked at earlier, where are these going to go? So this is what the markets are expecting. They're expecting by March of next year, there's 3 rate cuts. How many are there going to be? That's what we got to focus in on, but we need to focus in on the data we just don't have access to. So we're going to try to use all the data that we do have access to each day to come out and explain to you guys kind of basically what's going on with those and the whys behind it. So that'll be my report for today, folks, unless you have any questions. If you don't, I will be posting some videos, I think, over the weekend to help you guys understand how the markets work. And I'll also check out my shorts. I've been trying to do, short videos here and there just to intrigue you on some of our future videos and so forth. So I hope you like those as well. So other than that, guys, actually, we're having a chili cook-off at my home this evening, so I got to go start preparing for that. So I greatly appreciate you guys spending your Friday afternoon with me. And here in Chicago, it is 86 degrees and sunny, so I'm going to go outside and start setting up for our chili cook-off. If you need any assistance, folks, just go to therateupdate.com. Be more than happy to answer any questions that you have or help you in any way. Thanks for watching.